Most traders lose money because they jump into every fair value gap they see. But here's the truth. Not every FVG is worth trading, and if you don't know how to filter them, you're just gambling. In this video, I'll show you how I use a fair value gap leveling system, a simple but powerful way to rank and filter FVGs, so you only focus on the ones that align with the market's bigger story. So let's head over to the charts, and I'll walk you through real examples, step by step, so you can sharpen your price reading skills and make smarter trades. So I'm not going to spend time explaining what a fair value gap is in detail. If you're watching this, I'll assume you already have a basic understanding. What I want to point out here is this clear buy-side imbalance. Notice how, between this candle's high and the next candle's low, price only moves in one direction. That one-sided delivery creates what we call a buy-side imbalance, also known as a fair value gap. Now, sometimes you'll also see something called a volume imbalance. This happens when the candle bodies don't overlap on either side of the middle candle, like in this small area right here. When marking out fair value gaps, you want to include that volume imbalance as well. So, the correct way to draw this FVG would be from the high of this candle down to the opening price of the third candle. Keeping this in mind is crucial if you want to mark your gaps accurately. Now, let's take it a step further. If I'm bullish from a higher time frame perspective, of course I'm anticipating that the market is likely to push higher, but that doesn't mean I'm going to take every FVG I see. ICT doesn't enter on every single fair value gap either. What he's really doing is observing how price reacts when it taps into that gap. That reaction, that feedback, is what tells you if it's worth participating in the move or if it's better to wait. This mindset shift is key. FVGs are not automatic entry tickets, they're areas of interest. How price behaves inside them is what makes the difference between a random trade and a high-probability setup. Now, what do I mean by this leveling system? Let me break it down for you with a bullish, higher time frame perspective as our example. If price closes a down candle that fully rebalances a buy-side imbalance, and the close comes in at the discount end, I call this level 1 bullish. What this tells me is, in order to keep a bullish bias, the next candle needs to at least close above the consequent encroachment of that imbalance. Honestly, this isn't a signature I like to see if I'm already bullish, and if that candle closes below the discount low of the imbalance, then for me it's no longer bullish. At that point, I'd flip the imbalance and treat it as an inverse fair value gap, looking for resistance at the discount low or at consequent encroachment. If price fully rebalances the FVG, but the candle body closes at or above consequent encroachment, I call this level 2 bullish. This shows a bit more underlying strength. I'll then anticipate the next candle to find support at consequent encroachment or the premium high of the FVG. Again, I might not enter yet, but it's valuable feedback about the market's strength. If price wicks through the imbalance and then closes above the premium high of the FVG, that's level 3 bullish. This is stronger than level 1 and level 2, and I'll look for the premium high or consequent encroachment to hold as support, especially if consequent encroachment overlaps with the midpoint of the wick. If price closes above the premium high of the FVG, but leaves a portion of the gap unfilled, that's level 4 bullish. This is one of my favorite signatures, especially when it aligns with my higher time frame narrative. It's a clear sign of underlying strength and usually signals a powerful bullish move. If the FVG is completely rebalanced on the third candle, that's level 5 bullish. This is one of the strongest signatures I look for. Usually the move that follows is explosive. I'm comfortable placing a stop below that low because if I'm onside, it's highly unlikely price will come back. My absolute favorite is when the down close candle doesn't even trade into consequent encroachment of the imbalance. That's extremely bullish, and another setup I watch closely when I have a bullish bias. So here's the big picture. I'm not just using fair value gaps for entries or liquidity draws. I'm using them to measure order flow and the strength of the market. If I see level 4, 5, or this bonus signature, most of my trades are built around those. If price fully rebalances an FVG and then consolidates inside it, that's a red flag for me to pause and reassess my bias. This system is powerful, and it's really the missing piece of how to use fair value gaps effectively. Now, let's jump into some chart examples so you can see it all in action. For example, look at this chart. Here, the price had a strong drop and created a fair value gap. We mark the FVG that is in the premium zone and wait for the price reaction. When the price reaches the FVG, which level does it create? Yes, level 1, because its close is inside the premium FVG. So personally, I don't consider this setup very strong, and I wouldn't trade this FVG. And as you can see, the market later invalidated this FVG. Okay, let's move on to another example. Here we have an uptrend, and we're waiting for the price to return to this FVG to see its reaction. The price comes back to the FVG, and before it even trades into discount, it bounces and closes above the FVG. This shows us level 6, which is a very strong level, and here I would definitely take the trade. And yes, the market continues its move in the bullish direction. Alright guys, to keep the video from getting too long, I'll wrap it up here. Make sure to go on your charts and analyze FVGs using this leveling system, and you'll see how much it reduces your losing trades and increases your win rate. See you in the next video. Thanks for watching.